is risk management structure? Meaning of risk management in banking. The best sector of the organizations is banking. Risk management in banking refers to the identifications, measurement, monitoring, and control of risk to protect the bank's capital, earnings, and reputations. Banks face various risks such as credit risk, market risk, operational risk, liquidity risk, interest rate risk, and legal and reputational risks. One by one, we can see what are that all the risks. Credit risk first. Credit risk is just the risk that the person you have given credit to, that is the company or individual, will be unable to pay your interest or pay back your principal or its debt obligations. If you are investing in infrastructure, bonds, or company fixed deposit right now, you should be aware of the credit default risk involved. Government bonds have the lowest credit risk, but it is not zero. Think of Portugal, Ireland, or Spain right now. While low rated corporate deposits, that is, junk bonds, have, have high credit risk. Before investing in a bond or corporate deposit, be sure to check how highly it is rated by a well-known rating agency such as CRISIL, ICRA, or CARE. Remember, even a bank FD has some credit risk, as only a maximum of rupees 1 lakh is guaranteed by the government. Means you will get guarantee of 1 lakh from the government insurance guarantee corporations. I already discussed this point in our previous sessions, that for that you have to pay few amount for the future of your shareholders, investors, and customers. And every bank check our CIBIL before to give our loan, okay, or pass our loan. Without CIBIL, no one will pay you amount. If you will take a loan from the online sites or app, they will charge you a high level of interest that may be up to from 24% to 36% interest rate, and it is really too much high, and so many people have taken that loan and they are really facing great problems. They are even not able to pay principal amount because of their high rate of interest. Okay, so always take bank loan. It's a secured loan, and especially for from government banks. If government banks are means nationalized banks are not allowing us to sanction our loan, then you can move to the corporate banks. But after the checking of the profile of that bank and the policies of that bank about recovery of your loan, okay, and if you have given checks, post-dated checks at the time of loan sanction, you must have to keep attention that there must be balance in your account before to clear that check, or after check bounce you have to pay heavy charges. It may be from 200 to 600, or maybe very maximum rates from the corporate banks. Okay, credit risk arose because of the uncertainty about the discharging of obligations by counterparties. Statoil managed the credit risk concentration with respect to financial instruments by holding only investment grade securities distributed among a variety of selected issuers. A list of authorized investments limits by commercial issuer was maintained and reviewed regularly along with guidelines. This included an assessment of the financial position of counterparties as well as collateral requirements. The credit risk concentration with respect to receivable was limited due to the large number of counterparties spread worldwide in numerous industries. Before to take any loan, we must have to give few hypothecations, or we must have to give our property, okay, to set the hypothecation on that property. Okay, when you avail Satbara, your Satbara is also nominated with the bank's name. Means there are loan, or you have loan which is mentioned in that Satbara Utara. Okay, so it is also called as 7 by 12 extract, or Satbara extract. The credit risk from Statoil's over the counter derivatives contract derived from the counterparty to the transactions. Typically, a major bank or financial institutions, a major oil company, or a trading company. Statoil did not anticipate non-performance by any of these counterparties. Futures contracts had little credit risk because organized exchanges were the counterparties. The credit risk from Statoil over the counters OTC commodity based derivatives contracts resulted from the counterparty to the transaction. Brent forwards, other forwards, swaps, and all other OTC instruments were traded, subject to internal assessment of credit worthiness of counterparties, which were primarily oil and gas companies and trading companies. Credit risk related to commodity based instruments was managed by maintaining, reviewing, and updating lists of authorized counterparties, by assessing their financial position, by monitoring credit exposure for counterparties, by establishing internal credit lines for counterparties, and by requiring collateral or guarantees when appropriate. Collateral was typically in the form of cash or bank guarantees from leading international banks. Means we have to provide collateral securities. Few banks give up to 2 lakhs without hypothecations. Means they will take only checks, and on the basis of checks and your Aadhaar card and Uttara 7 by 12 extract, they will pay you the loan. But in this case, the loan rate will be always high. Means when you are taking a secure loan on lower list, there are so many procedures that you have to provide to guarantor. Those are the shareholders of that bank, and they don't have any loan. Okay, and others norms also available by the abide by the RBI. That is, the shareholder should not be a director or relative of the director of that bank. Okay, means even loan is not sanctioned to the director or the relative of the director. Okay, but the employee of bank or financial institutions can take loan from that bank. Okay, in case of interest rates, swaps, and currency swaps, counterparties were in general highly rated financial institutions. The credit rating were reviewed annually and counterparty exposures was monitored to ensure exposure did not exceed credit lines and compiled with internal policies. Non-debt related foreign currency swaps usually had terms of less than 1 year, and the terms of debt related interest swaps and currency swaps were up to 26 years, in line with that of corresponding hedged or risk managed long-term loans. Credit rating categories based on statoil groups, internal credit rating policies did not always correspond directly with rating issued by the major credit rating agencies. Internal rating were harmonized with external ratings were available, but could occasionally vary sometime due to different internal assessment. Consistent with statoil policies, commodity derivatives counterparties had been assigned credit ratings corresponding to those of their respective parents' companies, while there would not necessarily be a parent company guarantee from such parent companies is highly rated. I already explained you that the loan owner means borrower should not be director or parent of that institutions to avoid these types of frauds, because in Maharashtra so many banks made different types of fraud, and maximum fraud done by only directors. Financial instruments exposes Honeywell to counterparty credit risk. Honeywell managed its exposures to counterparty credit risk through specific minimum credit standards, diversification of counterparties, and monitoring concentration of credit risk. In general, Honeywell's counterparties were substantial investment and commercial bank with significant experience in the use of derivatives instruments. Honeywell continually monitored the creditworthiness of its customer in the normal course of business. Honeywell believed concentration of credit risk associated with the company's trade, accounts, and notes receivables was minimal due to its diversified customer base. But significant business came from its customers in the commercial aviation industry, aircraft manufacturers, and airlines, accounting for approximately 19% of its consolidated sales in 2001. Following the abrupt downturn in the aviation industry after the terrorist attacks on September 11, 2001, and economy slowing down significantly, the company modified the terms and condition of its credit sales to mitigate or eliminate concentration of credit risk with any single customer. We can find a aviation school near our college also. Hmm? In this way, credit risk at the time of passing the credits, you should have to check the security of your institutions, that whether the loan or amount you are sanctioning to a particular organizations or persons are safe, recoverable or not. If you are a bank manager, you should have to able to take the decisions to verify the profile of every organization and person. Few times what's happened in India before 2014, there were so many fake companies which already listed in share market, but there were no existence of that companies, and they are doing lots of businesses in crores and sold out their shares in the market. But after GST, all the corruptions and frauds stopped due to the new governments. Next, market risk. Statoil had established an enterprise-wide risk management (ERM) programs for managing market risk. The Corporate Risk Committee (CRC) met on a regular basis to review the existing policies and implementation of the guidelines. When a person buy shares of different companies, the companies may be private or governments. Okay, in that way, banks also invest in government and securities, government bonds, means which are related to RBI. Okay, and few times they take the permission from the officials to invest in personal, large or big companies also. Okay, but without permission, banks are not able to invest their money. Tata used a top-down approach to risk management, which highlighted the most important risk and then used a sophisticated risk optimization model to manage this risk. Statoil believed it had a comprehensive model which encompassed most significant risk and took into account correlation, different tax regimes, capital allocation at various levels, and value at risk at different levels with the goal of optimizing risk exposure and return. The model also utilized a sharp ratios which provided a risk-adjusted return measures in the context of a specific risk taken. The Corporate Risk Committee (CRC), headed by the Chief Financial Officer (CFO), and which included representative from the principal business segments, was responsible for defining and implementing Statoil's strategic market risk policy. The CRC means the Corporate Risk Committee made monthly to determine risk management strategies, including hedging and trading strategies and valuation methodologies. Statoil divided risk management into insurable risk, which were managed by a captive insurance company, tactical risk, which were short-term trading risk based on underlying exposures and which were managed by line management, and strategic risks, which were long-term fundamental risks and were monitored by the CRC, that is Corporate Risk Committee. To address tactical and strategic risk, Statoil had developed policies aimed at managing the volatility inherent in some of these natural business exposures. In accordance with these policies, it entered into various transactions using derivatives instruments because Statoil operated in the international oil and gas markets and had significant financing requirements. It was exposed to fluctuations in underlying interest rates, foreign exchange rates, and commodity, such as oil, natural gas, and refined petroleum products prices. Statoil used the derivatives to reduce the risk in overall earnings and cash flows. Total exposure was managed at portfolio level in accordance with the strategies and mandates issued by the ERM program and monitored by the CRC. Statoil mainly employed interest rate and currency swap agreements to manage interest rate and currency exposures. Statoil used the swaps options, futures, and forwards to manage its exposure to changes in the value of future cash flows from future purchases and sales of crude oil and refined oil products. The term of the oil and refined oil products derivatives was usually less than 1 year. Natural gas and electricity swaps, options, forwards, and futures were likewise utilized to manage Statoil's exposure to change in the value of future sales of natural gas and electricity. These derivatives usually had terms of approximately 3 years or less. Most of the derivatives transactions were made in the over the counter OTC market. Strategic market risk. Strategic market risks were reviewed by the CRC to reduce the likelihood of experiencing financial distress and to support the group's ability to finance futures growth even in downturns. Statoil had put in place various policies and procedures to reduce overall exposure to strategic risks. For example, Statoil's multi-currency liability management models sought to optimize the debt portfolio based on expected future corporate cash flows and thereby serves as a significant strategic risk management tools. In addition, the downside protection program for a crude oil price risk was intended to ensure that the business would remain robust even in the case of a drop in the price of crude oil. Tactical market risk, commodity price risk. Commodity price risk constituted Statoil's most important tactical risk. A substantial or extended decline in oil or natural gas prices would have a material adverse impact on Statoil. Historically, prices for oil and natural gas had fluctuated widely due to many factors that are global and regional economic and political development in resources producing regions, particularly in the Middle East, global and regional supply and demand, the ability of the organizations of petroleum exporting countries and other producing nations to influence global production levels and prices. Prices of alternative fuels, which affect realized prices under Statoil's long-term gas sales contracts. Norwegian and foreign governmental regulations and actions, global economic conditions, prices and availability of new technology, weather conditions, declines in oil and natural gas prices adversely affected Statoil's business. Lower oil and natural gas prices might also reduce the amount of oil and natural gas that Statoil produced economically or reduce the economic viability of projects planned or under development. To minimize commodity price risk, Statoil used the derivatives which consisted of futures options over the counter OTC, forward contracts, market swaps, and contracts for differences related to crude oil, petroleum products, natural gas, and electricity. Derivatives associated with crude oil and petroleum products were traded mainly on the International Petroleum Exchange (IPE) in London, the New York Mercantile Exchange (NYMEX) in the OTC Brent market, and in crude and refined products swap markets. Derivatives associated with natural gas and electricity were mainly OTC, physical forward and options, Nord Pool forwards, as well as future traded on the IPE. The maturity of crude oil and refined product derivatives was usually less than 1 year, while that of natural gas forwards was usually 3 years of less. The net fair market value of FAS 130 derivatives associated with long-term natural gas contracts, that is of 10 years or more, was NOK 91 million and negative NOK 145 million as of December 31st, 2002 and 2001 respectively. Also included in the fair market values and basis for sensitivity figures were immaterial derivatives position held for speculative purposes. Statoil estimated risk sensitivity by assuming a hypothetical across the board 10% adverse change in all commodity prices regardless of the term or historical relationship between the contractual price of the instruments and the underlying commodity prices. In the event of an actual 10% change in all underlying prices, the change in the fair value of the derivatives portfolio would typically be different from that shown due to expected correlation between risk categories. In addition, there would be expected offsetting effects from changes in the fair value of corresponding physical positions, contracts, and anticipated transactions, which were not required to be recorded at market. Change in certain underlying commodity prices in relation to other prices would typically result in other sensitivities. Natural gas sensitivities might, for instance, be adversely affected by certain relative commodity price changes due to pricing elements in long-term physical delivery contracts, an assumption used in arriving at the fair market value of FAS 133 derivatives related to long-term contracts. Equity price risk. Equity instruments were exposed to price risk. The fair value of these instruments was based on quoted market prices. Risk was estimated as the potential loss in fair value resulting from a hypothetical 10% adverse changes in quoted market prices. Actual results might vary due to derivations from assumption in utilized and risk correlations. Foreign exchange risk. Statoil's cash flows were largely denominated in currencies other than NOK. Cash receipts in connection with oil and gas sales were mainly in foreign currencies, and cash disbursements were to a large extent in NOK. Accordingly, Statoil was exposed to movements in US dollars, European euro, Danish kroner, Swedish kroner, and UK pound sterling. Total used a forward foreign exchange contracts primarily to manage existing receivables and payables, including deposits and borrowings denominated in foreign currencies. Currency options purchased in the OTC market for a premium provided Statoil with the right to buy or sell an agreed amount of currency at a specified exchange rate at the end of a specific period. The estimated loss associated with a 10% adverse change in NOK currency rates would result in a loss of fair value of approximately NOK 4 billion and NOK 5 billion as of December 31st, 2002 and 2001, respectively. A hypothetical 1 percentage points adverse change in interest rate could result in a loss of NOK 0.9 billion and NOK 1.2 billion related to interest bearing liabilities investments in debt securities and related financial instruments as of December 31st, 2002 and 2001, respectively. These estimated currency and interest rate sensitivity were based on an uncorrelated loss scenario. Actual results could vary due to assumptions used and offsetting account correlations not reflected within these analyses. Statoil's cash flow were largely in US dollars and euros, but there were also significant amounts in NOK, Swedish kroner, Danish kroner, and UK pound sterling. The currencies in the debt portfolio were managed in connection with Statoil's expected future net cash flow per currency. The debt after considering currency swaps was mainly in US dollars. Trading market risk arose from changes in market rates such as interest rates, foreign exchange rates, and equity prices, as well as their correlations and implied volatilities. DBS was exposed to trading market risk in the course of undertaking both proprietary and client related transactions. DBS had established limits to ensure that operations took place within the aggregate risk and concentration parameters set by senior management. DBS had adopted a daily earning at risk DEAR methodology to estimate the group's trading market risk with a 99% level of confidence over a 1 day horizon. DEAR was computed using a combination of parametric and historical simulation approaches. It took into account all pertinent risk factors and covered all financial instruments which exposed DBS to market risk across all geographies. On a daily basis, DBS estimated DER for each trading business unit. DER means daily earnings at risk, as well as for the group. These daily reports also provided DER estimates for individual activities and risk types such as foreign exchange, interest rate, or equity. To complement the DER framework, daily stress testing was carried out to monitor the group's vulnerability to unlikely but plausible events in extreme market conditions. Structural interest rate risk arose from mismatches in the interest rate profile of customer loans and deposits. This kind of risk was related to basis risk arising from different interest rates, benchmarks, interest rates, repricing risk, yield curve movements, and embedded optionality. In managing structural interest rate risk, DBS tried to achieve a desired profile, taking into account both the strategic considerations and market conditions to monitor the risk. Various tools were used, including repricing gap reports, sensitivity analysis, and income simulations under various scenarios. DBS attempted to limit the impact of exchange rates movements on its earnings where possible. Group's policy aimed at funding foreign currency lending with the same foreign currencies for foreign currency investments. The group's general policy was to borrow fundamental currencies. Non-fundamental or liquid currencies were sometimes hedged using other instruments, where appropriate for currencies with high hedging cost or lack of liquidity, alternative hedging strategies were used. Next is operational risk. Basically, we have seen that the word operational risk always associated with the production system in the company. But what about in bank? What is the production? The production is the production of loans, means to sanction the loans or to finalize the next systems or offers or interest rate. So operational risk is there. Operation risk in general, the principal raw material used in Honeywell's operations were readily available. Honeywell was also not dependent on any one supplier for a major portion of its raw material, but some important components and products, equipment, items were procured or subcontracted on a sole source basis with a number of domestic and foreign companies. Honeywell maintained a qualification and performance surveillance process to control risk associated with such reliance on these parties. Generally, when we use back office concept, which is related in banking also. In banking, where the operations are carried out, it is also called as back office. Though Honeywell's believed that the sources of supply for raw materials and components were generally adequate, it was difficult to predict the impact of shortages or price increases. A prolonged and substantial increase above recent historical levels in petroleum prices would adversely affect Honeywell's specialty materials businesses, which use the petroleum byproducts as raw materials. However, Honeywell had no reason to believe that a shortage of raw materials would cause any material adverse impact during 2003. Operational risk was the risk of a loss arising from inadequate or failed internal processes, people or systems, or from external events. Key elements of DBS operations risk management framework included risk and control self-assessment, risk event management, key risk indicators, reporting, process risk mapping, risk analysis and reporting, global insurance program, and business continuity planning program. Each new product introduced was subject to a risk reviewed and sign off process where all relevant risks were identified and assessed by departments independent of the risk taking unit proposing the products, variations of existing products, as well as outsourcing initiatives were also subject to similar process. Also related to reputational risk, which is we will think at the time of last our legal and reputational risk. Now we will discuss about liquidity risk means how much cash should be there in our hand in the bank. Liquidity obligations arose from withdrawals of deposits, repayments of purchased funds, and maturity and extensions of credit and working capital needs. DBS sought to manage its liquidity risk across all classes of assets and liabilities to ensure that even under adverse conditions, funds could be accessed at a reasonable cost. The primary tools for monitoring liquidity was the maturity mismatch analysis. The analysis included behavioral assumptions on customer loans, customer deposits, and reserve assets. Testing was done under normal and adverse market conditions. Guidelines had been established for the cumulative negative cash flows over successive time bands. In addition to reserve assets, DBS believed its source of funding was sufficiently diversified, including customer deposits, domestic and foreign interbank borrowings, and the swaps and repurchase markets. Additional foreign currencies liquidity was available through foreign currency deposits from overseas branches and subsidiaries. There is a fixed norms given by the RBI to all the banks that how much amount that they should have to keep for the distribution of loan. For example, bank has taken amount as a fixed deposit from the customers or from the shareholders, and out of that amount they will distribute only 60 to 65% amount as a loan. Means they have to play a game between only 60 to 65%, and they have to keep reserve rest 35 to 40% amount for all the emergencies or daily transactions. Means to pay cash to the customer on their demand. We have different types of accounts in the bank, that is saving account, current account, RD accounts, and other accounts. In current account and saving account, we can withdraw amount at any time. But for current account, you can take that current account without any interest rate, which will be provided by the bank. Means zero interest rate will be there on your deposits in current account, which will be used only for business purpose. And in a saving account, bank has to pay 3 or 3.5% interest rate. And if a saving account holder or current account holder customers came in the bank to withdrawal, bank has to pay him immediately. And other hand, if you will think about the FD holders should have to take their amount after their maturity. So the amount will be used for the loan purpose. Okay. Next is interest rate risk. The existence of assets and liabilities earning or paying variable rates of interest exposure Statoil to the risk of interest rates fluctuations. Statoil used the derivatives, particularly interest rate swaps, to alter interest rate exposures to lower funding cost and to diversify sources of funding. Under interest rate swaps, Statoil agreed with other parties to exchange at specified intervals the difference between interest amount calculated by reference to an agreed notional principal amount and agreed fixed or floating interest rates. The fair market value of assets and liabilities respectively related to fixed interest long-term debts. Interest rate swaps and currency swaps were NOK 2154 million. mean 2,154 million and NOK 28,625 million as of December 31st, 2002 and NOK 602 million and NOK 32,248 million as of December 31st, 2001. Fair market values of financial and commodity derivatives. Fair market values of commodity-based futures and exchange-traded options contracts were based on quoted market prices obtained from the New York Mercantile Exchange or the International Petroleum Exchange. Next is legal and reputational risk. What are the legal risks? Means when you are paying amount to the loan holder, there may be few crises, and when after bouncing the check, you should have to hire a case also. But before that, you should have to intimate to the client that if you are trying to pay the amount gradually, we will stop to file a case against you. Okay? If the client is ready, bank will not take legal actions against that client, customer, or organizations. For that, every bank has their legal advisors, which is a advocate or solicitor of that bank. And reputational risk. DBS believed reputational for integrity and trust was critical in the banking businesses. It emphasized the need to build a reputation for integrity and trust every day by demonstrating good judgment, applying high ethical standards to its work, and by acting within the spirit and letter of regulations governing its business as well as written its own code of conduct. Policies and, policies and rules DBS believed it was important not only to fulfill regulatory and legal requirements, but also to protect its franchise by actively meeting the expectation of its many constituents, including employees, shareholders, customers, regulators, and the public at large. Objective of risk management structure: ensure financial stability of the bank, protect depositors and shareholders' interest, combined comply with regulatory requirements, Basel's norm, RBI guidelines, optimize the risk return trade-off, maintain adequate capital and liquidity. Risk management structure in a bank. The risk management structure in bank is typically organized at three levels. A. Board of Directors role. Ultimate authority responsible for risk oversight defines risk appetite and risk tolerance, approves risk management policies and frameworks. Means key responsibilities: establish risk governance framework, review risk exposure periodically, ensure compliance with regulatory norms, oversee capital adequacy and ICAAP. B. Risk Management Committee RMC. Composition: board level committee includes independent directors and senior managers. Functions: monitor over overall risk profile of the bank, review risk limits and exposure levels, ensure implementation of risk policies, coordinate between different risk functions. Senior management, executive management role implements risk policies approved by the board, ensures day-to-day risk management. Key functions: develop risk measurements models, allocate risk limits to business units, ensure risk reporting, and MIS maintain internal controls. In this way, there is a chain from upward to downward of the director boards, committee, and managers. Okay, to finalize all the decisions. Chief Risk Officer (CRO) position independent senior executive reports directly to the CEO and board risk committee. Responsibilities: enterprise-wide risk oversights, integrate credit, market, operational, and liquidity risk, ensure risk culture across the bank, acts as license with regulators. Risk management departments, credit risk management departments, credit appraisal and rating, exposure limit and concentration risk, monitoring NPAs and provisionings, market risk management department, measurement of interest rate, FX, foreign exchange and equity risk, VAR and stress testing, trading book risk monitoring, operational risk management department, identification of process and system risk, loss data collection, business continuity planning. This is also measure and important aspects of data related to operational risk. When you are trying to enter your all the transaction in the computer with the help of software, your data may be secured. Means this is also part of operations. Liquidity and ALM departments, asset liability management, liquidity risk monitoring, interest rate risk in banking. Look, ALM is a main part of the bank, that is asset liability management. What is the asset liability management? Asset liability management is the process of managing the use of assets and cash flows to reduce the firm's risk of loss from not paying a liability on time. Well-managed assets and liabilities increase business profiles, profits. The asset liability management process is typically applied to bank loan portfolios and pension plans. It also involves the economic value of equity. Asset Liability Management Committee, ALCO, role manages balance sheet risk, ensures liquidity and interest rate stability, function monitor maturity mismatches, manage funding and pricing strategies, review interest rate sensitivity. Three line of defense model. First line business unit, second line risk and compliance, third line internal audit, risk reporting and MIS, periodic risk reports to board and regulators, stress testings and scenario analysis, early warning signals. And last point, importance of risk management structure. That's are prevents bank failures, enhances financial resilience, improve decision making, builds stakeholders confidence. Thank you to all. The session is over.